Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room, live streaming from YouTube. This report is this live session is for July 1st, 2021. The U.S. jobless claims came out just a few minutes ago. We're going to be taking a look at those numbers, and we are also going to be taking a look at the gold market, silver market. We'll take a look at the GBTC, which is the Grayscale Bitcoin Investment Trust, and we'll take a look at Coinbase as well. Stay tuned. I'll be right back. Gold is trading last at 1780. We've had an interesting morning here with the gold market. The market pretty much has completed the sell one level of 1779. As you can see, it's up about $9 roughly, approximately, and we continue to basically move up since the bottom of the market was made here a few days ago. And it is beginning to look like we might have completed this bottom here at the low of 1750. And this low came in right into the buy 2 weekly that we published in the Associated Press, basically, and Seeking Alpha, that we were expecting a reversal from the 1749 level. And if you go back just a few videos, I talk about basically the blue levels here that we're in, which indicate the market is extremely oversold. As it approaches these levels, I've recommended that this was a high probability area for you to accumulate if you're a self-directed trader. If you're just coming and joining me here, the blue levels basically represent the level of support. In most conventional technical analysis, it represents support. The algorithm identified by converting these pivot points into active algorithms, it alerts us when the price is completed or within a realistic distance. And I give myself about a 10% room of error, margin of error, always exiting and entering a position just to make sure, because the markets never really get to the number all the time. And you as a self-directed trader, if you can make 80% out of 80 cents out of a dollar, that's going to be pretty good. And if you do it, 70, 80% of the time, making that kind of return, you're going to be ahead of the game when you're trading in the futures markets, or when you're trading basically this volatile instruments. And so what I'm showing you here is basically how I define the VCPMI into these levels here. And basically it recommended for us that over the last couple of days, the blue level represents a very strong area mathematically that the market could revert from there. and as it has. And we in 2 days from a low of 1750, we met basically the first target, which is 1781. And here's the situation that is a little bit ambiguous, that I really call the gold market is ready to rumble. And what I mean by that is that we have entered now, as you can see, a bullish pattern, a daily average above, a market trading above the daily average of 1766, activated a bullish uptrend with a target of 1779. A weekly close above the buy one weekly, which we had all this week, by the way. 1765 was a trigger point, and automatically when that signal was activated, it activated also the weekly target of 1781. And we are completing those targets as we speak, as you can see here, from both trends, the daily trend and the weekly trend. The target on the daily is being completed, while the weekly average price now, if it trades above 1781, it's going to activate a bullish price momentum into a level of distribution of supply on the daily. But the supply area tells us that the supply range is 1779 to 1788. And so the initial targets, if you went long at this harmonic level that we see here, 1765, 1766, pretty close to perfect alignment. And this is one of the things that I teach my traders in my private trading room. Basically, these are the most optimal relationships the algorithm can identify. And when it does identify this relationship, there is a very high probability mathematically, although nothing is a guarantee when you get to these levels, that you're going to see some kind of a reversion unfolding or reaction unfolding. So we have a little bit of an ambiguous signal in that the daily target is entering a resistance level, an area of resistance. And to be more precise, the VCPMI, or the algorithm, identifies the mathematical probability that from cell 1, you're looking at anywhere from 90 to 95% to cell 2. So you still have, still 5-10% probability that the market can still run up to 1788. And that will validate and support basically the weekly bullish price momentum that's being identified right now. And this is how you would pretty much connect the daily to the weekly and see where we are between the two. And as you can see, when we get to a harmonic relationship here, also here between the cell 1 and the cell 1 level of 1779 and the weekly average of 1781, you're going to see the energy change. You're going to see the energy, the supply and demand to be more active. The exchange of the supply and demand at these levels is going to be more active. And depending upon the strength of the buyers underneath, or basically the price momentum shifting, it will determine basically whether the price is going to reflect that strength into the next target zone, which is basically the 1788 level. What I mean by that is essentially what reflects in the price is the resolution of the algorithm, the momentum of the algorithm, And the momentum of the algorithm basically takes into account the strength of the buyers. And if you get more buyers, ideally, you know, when, for example, here, this the code identified for us in the last few days, this is a very strong area, particularly after making the low of 1750, that you are going to see and identify buyers. And that you don't want to sell into this, even though it can come down from B1 to B2. What you want to prepare for is the energy shifting, buyers coming into the market, and then activating the trigger on the close above 1758. That activated a daily trigger. The target 1766 was right above it, and it was completed, and pretty much it closed also above the weekly by one weekly level of 1765. And when it did that, it automatically activates these levels above that we're talking about right now as being completed. Now, what's going to determine basically the continuous momentum of the market is the strength of buyers underneath the signal. And more buyers would be reflected obviously in the green bars, which essentially means that they are taking all of the supply that is suggested based on the daily signals that we can experience from 1779 all the way up to 1788. Now, 1788 is the sell to level. So what happens if the market closes above 1788? By the way, that's a good question. What happens basically is the daily goes neutral. It completed the pattern. It goes neutral, and then the algorithm focuses on the weekly, on the next weekly target, and in this case, it's 1797. And then you start to deal with the weekly numbers. 1797 to 1812 is the sell to level. And as you begin to see the market move up at these levels here, taking out the daily and then, let's say, neutralizing the weekly, then we're looking at the monthly numbers. And then when the monthly numbers are taken out, obviously, then you look at the yearly numbers. But the whole idea is that the algorithm creates a thread, basically, between all the trends in engaging the harmonic relationship when the price is at the extremes above or below the mean. And ideally, when you can connect that relationship harmonically aligned in all of the trends, it is a very, very high mathematical probability that a shift in the momentum is going to change. What we're looking at here, if we come back to the market, is the ambiguous signal that we are looking at between the daily and the weekly, that you're going to be experiencing volatility for a short while until the market defines the momentum again. But I want to take this opportunity and pretty much show you what a very dear friend of mine created, who also was a trader, and understood the physics of the algorithm, basically, and created this incredible tool that explains to you basically the physics of the algorithm behind it. As you see here, let's say this is the structure of the 5 levels here, and what happens is when you push the energy to its extreme below, or you might say the extreme at the maximum level, what happens is the physics, the energy of the market reverts back up automatically. And this is the momentum that I refer to as the VCPMI, which is the variable changing price momentum indicator. If you push the prices to the extreme above, what will happen is the physics again will revert the energy back down into the mean or the average price. The extreme below, it will revert back up. The extreme above will revert back up always to the mean. And this identifies basically the methodology, the mathematical scientific methodology of the physics behind the algorithm. Let's come back here to the market. And so this is what we're looking at in terms of the structure, the 5 levels. And what happened here is when the price was pushed down to the extreme at 1750 here, we came down to the extreme below that mean, and this is the reversion unfolding here that we look for. And the reversion has taken us now into the daily, the weekly, and now it's entering into the pretty much the weekly pattern. So you can see here the signal on the sell 1 daily was so far pretty predominant at these levels here in going short at this close at the 76.20. And that, so the way that I look at this, and for example, for you as a self-directed individual, if you came in long, these are places for you short term that you want to take profits. Automatically, these are your targets if you are long from, that 1750 area that we recommended. You're looking at about a $25 solid profit move. That's a pretty good move here in just the last couple of days. The signal here is activating now after completing the target, the pattern. You go neutral. You look again at the algorithm. In using the 15-minute bar close, you see where the market is. And here, it completed the pattern not only for the daily sell 1 level of 1779, but also the weekly. And now we've entered a weekly bearish price momentum now because we're trading below the average, and activated a daily short trigger at 1779. This is a day trading short trigger that you as a self-directed individual, you can use these signals to day trade the market without affecting your bias, so to speak, on your underlying position, your core position, which could be very, very bullish. So, and I am carrying long portfolios underneath the market. And so how do I, what do I do today here? Well, obviously I have the option that I can go short here at the close of this bar at 7:30. I'd lock in, or, lock in some profits, hedge up here. It gives you several options that you can apply depending upon you as an individual in your portfolio. One of the things that I have found after doing this for so many years is that not every trader is homogeneous, and you can't box every trader into a particular mold, because again, trading is very personal, I found. And so and which is one of the reasons why, I created this algorithm, is because I want to get myself away from the decision-making process, the emotional decision-making process. And that's what this algorithm has done for me. Clearly tell me, like a GPS, when I want to go trading, where the extremes are in the market above or below, where the average price is. And again, it tells me pretty much where to expect a shift in the psychology, you might say, of that supply and demand, or at what levels, extreme levels mathematically, we can expect that. And when the market confirms it, that's when I, as a trader, have the choice to either take it or not take it. The robot does not think, does not use emotion. It simply executes the signal in easy language. And pretty much when you think about this, what I'm doing here is I'm simplifying, reversing that engineering and coding in easy language and sharing this with you as a self-directed individual like you, like I am. I use this information for that purpose. And so if I can use it, translate it, I'm sure that you can accomplish similar success or even greater success, depending upon, again, your profile. So it's all a question of managing risk. Really, what when we talk about trading, particularly when we're trading in the futures markets or trading in the markets in general, and it's learning how to manage the risk of an instrument depending upon the, you might say, climate of volatility that you're dealing with. For me, high volatility is a trader's dream, because I don't look at it as nothing but an opportunity that essentially represents something got to an extreme. When the market reaches a level of volatility, a high level of volatility means that something is at an extreme above or below. And that's a kind of a really a green light for the VCPMI, because that's what it identifies, is those extreme levels with very high probability. And so depending upon, again, your model, depending upon your objectives in trading, you can apply this very much like a GPS. I reserve the right to not take the short signal here. I don't essentially want to take this signal simply because it's a bit ambiguous. If it was a little more clear, you might say with a weekly average, I probably would take the risk, and I don't recommend to trade that. But again, you're a self-directed individual, and I'm teaching you the methodology here. So the signal is short, but it will reverse or negate on a close above 79 once again. And if it runs up above 81, it's going to reactivate the bullish uptrend, which is really kind of what I'm looking for. The fact that the market is approaching levels where it would negate, let's say, the short-term trends, it means the market is making an adjustment and possibly reversing the bearish trend, for example, that we're in, which is really what we're talking about. And because it usually starts in the shorter time frames. Even the cycles develop in the minuet, or the minutes, and then the hours and the days and the weeklies and so on and so forth. So the algorithm is very sensitive to a shift in that pattern, and that's what the alignment that I talk about identifies. The change in the shift of the energy or of the market, which is translated basically into the momentum. So I'm holding on to my long-term core position. I'm suggesting my traders to hold on. When the price is that ambiguous, the AI obviously tells you to trade from the highest probability levels as an individual trader. And that would be that if the market comes down to that 1766 area once again, that would be an area to focus on to re-enter the market on the long side. If it comes down. So it's a bit ambiguous. It's a big if between 1779 and 81, breakout above, and 65, 66, a bottom of this range. So let's allow for the market to do its thing. We're gaining equity on our core position this morning, so I'm very comfortable. I don't need to push the trade. Let's see what the market does throughout the day. And we will continue basically to update you here in our live trading room throughout the day, and anything that develops in the market will be updated. Thank you again for the opportunity, my friends, to share this with you, and I do hope that it is making a difference to your trading by coming here every day. Thank you, and we'll talk to you soon.